Let me show you something. You're looking at two investors, Steve and Tony, during one of the most chaotic years in recent market history, 2008. They both had the same amount of money. They both invested in the exact same market, but they made different choices. On April 1st, both of them thought the bearish trend was over. They believed the market was near its bottom. It doesn't matter what their reasoning was. They simply made the decision and chose to invest in the stock market. For a while, Steve was doing relatively better than Tony. On May 6th, Steve's portfolio had increased by 3.98%, which means he made $3,982 in just 1 month. In contrast, Tony's portfolio only grew by 0.56%, just $560. You might think Tony had massive FOMO, right? But no, he didn't. Starting in May 2008, stock prices began to plummet. The downward trend continued until March 30th. At the bottom of the market, Steve's portfolio had dropped to $57,675. Meanwhile, Tony's portfolio was sitting at $74,290. Tony didn't escape the recession that left a scar on the global economy, but he was able to recover quickly. In fact, by October 2009, he had fully recovered and started generating profit. And Steve? By the end of 2009, his portfolio was worth $81,575, still far from recovering his original investment. So what investment strategies did Steve and Tony use? What made the difference between two people who started in the same financial position? We'll come back to that in a bit, and I promise it's something you'll want to know, especially in a market as chaotic as 2025. Today, I want to talk about something that sounds simple, but trips up almost everyone: buying the dip. If you spend any time online, you've probably seen that phrase tossed around like a magic spell. Stocks fall and people say, buy the dip, as if it's easy, as if it always works. But the truth is, buying the dip isn't about catching the bottom. It's not about being right, and it's definitely not about being fearless. It's about something quieter and more powerful. It's about staying steady when the world feels anything but. And if we go back to our two investors in 2008, here's what actually happened. Steve put his full amount into the market right away, early, fast, and all at once. He was confident the market had hit the bottom and believed it was worth going all in. Tony took a different approach. He split that same amount evenly across the next 12 months, one piece at a time. No trying to time the bottom, just calm, consistent investing. So who came out ahead? As you saw earlier, it wasn't the bold move that won, it was the boring one. Tony ended up with a better average cost, less stress, and a stronger position heading into the recovery. That's the part of buying the dip that never gets talked about. You don't need to call the low. You just need to keep showing up. We saw this again in 2018. Trade wars hit the headlines, tariffs came in, the S&P 500 dropped almost 20%. It felt dramatic. It was dramatic. But if you stayed in, you were fine. If you paused, panicked, or waited for things to feel safe, you probably missed the rebound. And now here we are again. The same worries, dressed up in different clothes. Inflation, recession risk, political noise, global tension. But underneath all that, there's still momentum. AI is driving real productivity. Bank of America reported one of the largest weekly inflows into equities since 2012. That's not fear. That's people building quietly while the headlines shout. Even the skew index, a measure of how worried investors are about big drops, spiked recently, then dropped fast. That tells us something. We're probably not at the start of panic. We might be near the peak of it, and that's when it's hardest and most important to stay steady. Buying the dip isn't about being brave. It's about being ready, not to make some heroic move, but to keep building through the fog, even when it doesn't feel like progress. Larry Fink from BlackRock put it this way: yes, volatility is here, but this is not the end. It's a time to build. And the people who succeed, they're not the ones who flinch. They're the ones who stay. So what does that actually look like? It looks like consistency. Like investing even when it's uncomfortable. Like choosing not to flinch when the market tries to test you. It means having some cash aside, not to predict, but to lean in quietly when others are loud with fear. It means remembering that resilience isn't flashy, but it works. Because you're not here to be perfect. You're not here to call bottoms. You're here to build slowly, steadily, through the noise. That's what Tony did. And that's why they came out ahead. And if you want to go deeper into how to invest with clarity when the outcome is uncertain, watch my video on investing with probability.